Decades ago, building a diversified portfolio meant sitting across a desk from a financial gatekeeper, paying heavy commissions to pick single stocks one by one. Then the index fund came along. It allowed regular investors to buy a tiny slice of the entire market all at once, driving down costs and making wealth building widely accessible. Today, when you open your brokerage app to buy one of those indexes, the interface presents a choice between two practically identical options. Those options are the exchange-traded fund, or ETF, and the mutual fund. They hold the exact same underlying assets. If you track the S&P 500, both baskets contain the same 500 companies in equal proportions. The difference is the packaging. The wrapper dictates how you trade, the fees you pay, and how the IRS taxes you. While the contents are identical, the hidden plumbing of these two structures determines how effectively they serve your specific financial goals. The first mechanical difference is how and when these wrappers process your money. If you buy or sell a mutual fund, the transaction only goes through once a day. It processes after the market closes, at the exact net asset value of the stocks inside. ETFs operate differently. They trade continuously on an exchange throughout the day, just like an individual stock. If the market drops at 10:30 a.m., you can buy an ETF right then and lock in that exact price. That control comes with a trade-off. Trading on an open exchange exposes you to market mechanics like the bid-ask spread, the gap between what a buyer is willing to pay and a seller is willing to accept. When you buy an ETF, you have to cross that spread. This means you might pay a slight premium above what the underlying stocks are actually worth at that exact second. ETFs offer immediate execution at the cost of spread volatility. Mutual funds sacrifice that intraday control to guarantee you pay the exact underlying asset value. The second major mechanical difference is how these vehicles handle taxes. Mutual funds have a structural quirk. When a large group of investors wants to cash out, the fund manager has to physically sell underlying stocks to hand them cash. Selling those stocks triggers capital gains taxes internally. The IRS requires the fund to distribute those gains, which drops a tax bill onto all the remaining shareholders at year-end, even the ones who didn't sell anything. ETFs bypass this problem using a specialized plumbing mechanism called an in-kind transfer. Instead of selling stocks for cash to meet redemptions, a middleman simply swaps a basket of physical stocks for ETF shares. Because no cash actually changes hands inside the fund, no capital gains are realized at the fund level. That annual tax drag is significantly reduced. If you are investing in a standard brokerage account, this makes ETFs highly effective at protecting your compounding growth from yearly tax erosion. But there is a caveat. If you hold your investments inside an IRA or a 401k, those accounts are already tax sheltered. In these cases, the ETF's structural efficiency provides no additional benefit. In-kind transfers act as a protective shield against tax drag. You just have to be in a taxable environment to receive the benefit. Look at this stock market data bank. This grid of numbers represents the final, hidden metric you need to check: how accurately your chosen fund actually follows its target benchmark. First, look at tracking difference. This is the simple, annualized gap between the market index's return and your fund's return, and it is almost entirely caused by the fund's internal fees. Then, look at tracking error. This is a completely separate metric that measures volatility. It tells you how consistently the fund followed the index on a day-by-day basis. Think of the index as a lead car driving down a highway. Fund A is a second car following closely behind. Fund A stays perfectly centered in the lane, but the gap between it and the lead car slowly widens by a few inches over 100 miles. That is a low tracking error, but a clear tracking difference. Now picture Fund B. It is constantly swerving left and right, hitting the rumble strips and riding the bumper. Fund B might accidentally cross the finish line at the exact same distance behind the lead car as Fund A, but the journey was chaotic and unpredictable. That is high tracking error. A low advertised fee isn't enough on its own. You need a low tracking error to verify your money is predictably replicating the market's performance. So how do you decide between the two? The answer depends entirely on your account type and your desire for automation. Let's look at the tax-conscious optimizer. This is someone using a standard taxable brokerage account who wants to keep every possible penny invested in the market. For this group, the ETF structure is highly effective. Its in-kind exchange process minimizes capital gains distributions, keeping more of your money working over time. Now consider the set-and-forget investor. This person is putting a portion of every paycheck into a tax-advantaged account like an IRA or a 401k. For them, the path often leads to the mutual fund. Because the tax efficiency of the ETF structure is irrelevant inside an IRA, the mutual fund's simplicity takes the lead. You get automated fractional reinvesting and guaranteed end-of-day pricing without navigating bid-ask spreads. But here is the most important takeaway. Selecting a structural wrapper should never delay the actual act of investing. Whether you prefer the automated precision of the mutual fund or the tax-shielded flexibility of the ETF, the market's growth remains the primary driver of your wealth. Pick the vehicle that fits your life and let the market do the work.